Now let's talk more about the market with Scott Wren of Wells Fargo Investment Institute. Scott, welcome. So the S&P closed today right around that level where it chopped around in mid-June before going higher, where it also bounced in mid-August. What's the significance of the spot where we are now?
Well, John, I tell you, I think if you look at it from a technical perspective, we've held in here pretty well. We almost touched the 200-day moving average in the S&P 500, which I thought we were going to do for sure. We got close, didn't quite get there. And really, so I think we're between now and 4460 is where I see at least technical resistance on the upside. And then that 4200 are close to 4200 for the 200 days. So I think right now we're between there. Tomorrow's clearly going to be a good day. If we had something, core CPI comes in at 3.9% or something like that, I think the bond market and stock market would like that. But, the thing for us is there are headwinds. The Fed's probably does have another hike in them. And believe me, if we see this core CPI stall at 4.1, 4.2, something like that over the next couple of months, the Fed's almost has to hike here because that's way above where they want to see it.
Now, Scott, you're saying, if I understand you, to expect a stock and bond rally tomorrow if CPI comes in below 4%. Consensus, though, is 3.6%. From what I can see, that gives a lot of headroom above consensus to still get a rally. But it sounds like you're inclined to say sell that rally.
John, I think that's the headline estimate. I think the core is a little bit lower than that. 4.1, I think, is the core consensus out there. And so, I think still that 4.3, if we stall out there in terms of core CPI, I mean, the Fed's not going to put up with that. But if we start seeing some numbers here in the threes, which we certainly expect inflation to go down, we just think it's going to take a little bit longer than I think the market is expecting. So, we want to see a good inflation number. Certainly, this crisis in the Middle East, as far as the financial markets go, that's going to be an oil price type of situation. And we saw a little upside and oil's bouncing around between 80 and 90. If this is really protracted, some other players get involved. Maybe we see oil bounce higher, which wouldn't be good for the global economy. But overall, for us, we've been playing defense. We think the stock market probably has some lower levels in it. Our official target for the end of this year is 4,100. So we think that's a good opportunity to pick up stocks right there. But between here and there, we're going to play a little defense.
Okay, so what does defense look like? And I ask that because, yes, today real estate and utilities actually led the S&P higher as we saw yields come down on the long end of the curve in the Treasury market. But consumer staples, for example, have just been hammered, and that continued again today.
I tell you, Morgan, these higher rates have hurt, let's say staples, utilities, those kinds of things. So in our minds, playing defense, when equities rallied, we backed off of technology, we backed off of stocks in general, we took some money out, we parked it in short-term fixed income. Clearly, those, whether you look at 3, 6, or 12-month bills, those yields are all pretty nice right now. And that's exactly what that is for us, as a parking spot, because we do expect opportunities to step back into stocks at lower levels. So if you look at our sector favorites right now, materials and industrials are two of those, which may sound kind of odd if you're trying to play defense. But, for us, we've got a lot of infrastructure spending that's going on, a lot of deficit stimulus infrastructure spending. That's not going to end anytime soon. As a matter of fact, it's going to accelerate. And then we've got healthcare as another favorite there, too. So I would say that, being underweight stocks, overweight short-term fixed income. We've also been talking to clients about taking advantage of these higher yields. We just don't think, for instance, the yield on the 10-year Treasury is going to go a heck of a lot higher than where it is now. We think those are the opportunities right now that we want our clients to be taking advantage of.
Okay, sounds good. And, of course, we get earnings kicking off in earnest with the banks here on Friday, and a couple names even before that as well. Scott Wren, thank you.
All right, thanks, guys.